Welcome back to the Deep Dive. Today, we're really diving in, strapping in, you could say, for an exploration of something that, well, it aims to change how we even think about money.
That's right. We're digging deep into Bitcoin. But we want to cut through all the daily price swings and the
Yeah,
noise.
get to the heart of it,
Yeah.
understand what it actually is, both as a piece of technology, a pretty robust one, and importantly, as this powerful economic idea with real historical roots.
And for this journey, we're grounding ourselves in a really comprehensive source. It's important to mention this deep dive is part of the series Os Livros que me tornaram quem sou. That's the books that made me who I am by Dr. Dario Santucci.
Right, and our specific source today is Fernando Ulrich's work. We're looking at excerpts from his really influential 2014 book, Bitcoin, Moeda in an Era Digital.
Ulrich's book is key because it doesn't just look at Bitcoin as some, tech gadget in isolation.
No, definitely not. It connects it rigorously to the history of money, and it uses a tough framework, Austrian economics, especially Mises, to really test its legitimacy.
So our mission today, it's pretty clear. We want to give you, the listener, a kind of thorough shortcut.
A shortcut past all the usual media chatter.
Exactly. To really grasp Bitcoin's core, the tech, the economics, why it might be considered legitimate money under certain frameworks, and maybe most importantly, the huge political implications it has for, well, monetary freedom.
But let's frame it like this from the start, sort of a hook for our discussion.
Yeah.
The source really pushes us to see Bitcoin not just as another way to pay online, but potentially as, and this is a big claim, the greatest technological innovation since the internet. Something that could revolutionize money, just like email, totally change communication.
Leaving the old ways, the centralized trust-based systems, looking as, well, outdated as sending a physical letter, maybe?
That's the potential we're exploring.
Hey.
Okay, let's start with the absolute basics then, because the definition itself, it really holds the whole design philosophy, doesn't it?
It really does. When you define Bitcoin, you have to hit two things right away. P2P and open source.
Peer-to-peer, so directly between people.
Exactly. Purely digital and peer-to-peer, meaning transactions go straight from me to you, no bank or payment processor in the middle.
And open source. Why is that critical?
Oh, it's fundamental. The code is out there for anyone to see, to check, to audit. And crucially, it's not issued or controlled by any government, any central bank. No single entity can censor it. Its value comes entirely from people choosing to use it, from the market.
Which, practically speaking, made it useful early on for online stuff, fast, cheap, relatively secure. But the real breakthrough, the genius part, was solving that big problem.
The double spending problem. Yeah, that was the mountain nobody could reliably climb before Bitcoin.
Explain that for us. Why is double spending such a hurdle for digital money?
Think about physical cash, like a coin. If I give you the coin, I physically don't have it anymore. Simple. But digital information, like a photo or, an instruction to transfer money, it's just data.
You can copy it infinitely.
Precisely. Before Bitcoin, if I sent you digital coin X, what stopped me from immediately copying that same digital coin X and sending it to someone else too? Nothing inherent in the data itself.
And that's why we always needed the middleman, right?
Yeah.
The banks, Visa, PayPal.
Exactly. They acted as the trusted third party. They kept the official private ledger. They made sure when I sent money, my balance went down immediately, definitively, so I couldn't send it again.
Bitcoin's revolution was basically saying, we don't need that single trusted entity anymore.
Right. It solved double spending without the central authority, and it did this by, well, distributing the job. That crucial historical record, the ledger of who owns what, it's shared across all the users, all the nodes in the network.
And that shared ledger is the blockchain.
That's the blockchain.
Okay.
A public, continuously growing, verifiable record of every single transaction distributed everywhere.
So the intermediary is the network itself.
Yeah.
In a way. Okay, let's get into the mechanics a bit, because the security relies heavily on cryptography, specifically public key cryptography.
Yeah.
How should we visualize these keys?
It's like having a digital mailbox with a special key system. Everyone gets a public key. That's your Bitcoin address, like your email address or street address. You can share it freely for people to send you money.
That's where money comes in.
Right. But then you have a private key. This is the secret. It's like the unique physical key to your ultra-secure lockbox. You never share this. To send money out, you have to use this private key to digitally sign the transaction.
So the signature proves I own the funds without me actually revealing the secret key itself.
Exactly that. When you create a transaction saying, send X amount to this public key, you sign it with your private key. The whole network can then use some clever math to verify that the signature is authentic, that it came from the owner of the funds associated with your public key, but they never learn your private key,
It's mathematically verified ownership transfer.
making it legitimate and, importantly, irreversible once confirmed.
Okay, so transactions are created, signed, verified. Then they need to be recorded permanently. They get put into blocks, right? How does the blockchain stay secure and in order?
Right. These verified transactions get bundled together, time-stamped, and put into a block. But for that block to be officially added to the end of the existing chain in chronological order, it needs to be sort of sealed cryptographically.
And this sealing process, this is mining.
That's mining.
This seems like where the economics and security really fuse. We hear miners solve complex problems. What are they actually doing?
They're dedicating enormous amounts of computing power, specialized hardware, lots of electricity to basically run through calculations, specifically hash algorithms. They're all competing to find a very specific number, a nonce, that when combined with the data in the new block produces a cryptographic result that meets certain criteria.
So finding the right number is incredibly hard, computationally expensive.
Extremely hard. It's like trying trillions of combinations.
But checking if someone found the right number is easy for everyone else.
Instantaneous for the rest of the network to verify, yes. So the first miner to find that valid solution gets to propose their block containing all those verified transactions as the next block to be added to the chain.
And what's in it for them? Why spend all that money on hardware and electricity?
The incentive structure. It's crucial. Two parts. First, the miner who finds the block receives a reward of newly created bitcoins. This is how new Bitcoin enters circulation. It's called the block reward, or seigniorage.
The system's own money printing in a controlled way.
In a very controlled, predictable way. Second, they also collect all the small transaction fees that users included with the transactions in that block.
So the reward justifies the cost and effort. And that effort is what secures the network against fraud.
Precisely. The sheer cost and computational difficulty make it practically impossible for any single entity to overpower the network and rewrite the transaction history or double spend. The economic incentive directly fuels the security model.
And the economic brilliance, from the Austrian perspective Ulrich uses, is that scarcity. The source really emphasizes the increasing difficulty, the halving of the reward, and that hard cap, 21 million bitcoins. Why that specific limit?
That 21 million limit is baked right into the core code, the protocol. It's designed to create absolute, predictable digital scarcity. The halving, where the block reward gets cut in half roughly every 4 years, controls the rate at which new coins are issued.
Making it slower and slower over time.
Exactly. It mimics how mining a real commodity, like gold, works. It gets harder and more expensive to extract the remaining supply. So even though something like 90% of all Bitcoin was already mined by 2022...
Wow, 90% already.
Yeah, the issuance slows down dramatically.
Right.
The very last fraction of a Bitcoin, the last Satoshi, that's the smallest unit, like a cent, but Bitcoin is divisible to 8 decimal places, won't be mined until somewhere around the year 2140.
So centuries of decreasing supply issuance.
This mathematical scarcity, enforced by code, not by anyone's decision, is absolutely fundamental to its potential as a form of money.
Okay, let's touch on identity. We often hear Bitcoin is anonymous, used for illicit things, because it's like digital cash. But the source says, hold on, that's not quite right.
Yeah, that's a really common misconception. It's crucial to distinguish. Bitcoin operates on pseudonymity, not true anonymity.
What's the difference in practice?
Every single transaction, the amount, the date, the time, the sending and receiving addresses, the public keys, is permanently etched onto the public blockchain for anyone to see. The network itself is radically transparent.
So where's the privacy then, if it's all public?
The privacy comes from the fact that those public keys, those long strings of characters, aren't automatically linked to your real-world identity like your bank account is. You don't need ID to generate a Bitcoin address.
And this is the key part. If someone can link your real identity to one of your public keys.
Then the pseudonymity breaks. If you buy Bitcoin from an exchange that requires KYC, know your customer documentation, like a passport scan, well, they know that address belongs to you. Or if you post your address publicly online to receive donations, or use it for an online purchase where you give shipping details.
Then your entire transaction history associated with that address becomes traceable back to you.
Exactly. All of it, forever on the public ledger. And the source points out this isn't just theory. Researchers use sophisticated techniques called clustering analysis to follow the flow of funds and link addresses together. One study apparently managed to de-anonymize about 40% of users in their simulation just by analyzing transaction patterns.
So achieving real strong privacy requires extra steps, extra tools, beyond just basic use.
Definitely. But, and this is also important, even with this public ledger, the level of privacy for the average user is arguably still far greater than using, say, a credit card or PayPal. Because with those systems, a central company knows everything. Who you are, what you bought, where, when. And that data is easily accessible to governments. With Bitcoin, even if traceability is possible, you're not automatically handing over your entire financial life to a single data-hoovering third party just to make a transaction. You remove that central point of control and surveillance, at least initially. Hashtag tag 3. The historical and political context. You really can't understand Bitcoin without looking at when and why it was created. The timing wasn't accidental. It was born directly out of a specific crisis.
The 2008 global financial crisis, right? The source argues this was the main catalyst, revealing just how fragile the whole centrally controlled system was, and the response to it.
The response was arguably even more important. The unprecedented discretionary actions by central banks and governments, it shook public trust to the core.
Ulrich's analysis using that Austrian lens is quite critical here. He describes the existing system as resting on two, let's say, questionable pillars.
Yes. First, the government's monopoly on issuing currency. And second, the central bank's total control over the banking system. He essentially calls this a kind of monetary socialism.
And when big players like Lehman Brothers collapsed, the reaction wasn't based on preset rules, was it?
Not at all. It was pure discretion. We saw quantitative easing, QE, interest rates pushed near zero, massive bailouts for banks considered too big to fail, even outright nationalizations in some cases, all decided on the fly by committees.
Let's unpack QE a bit. People hear the term. But what exactly is it, and why is it viewed so negatively from this perspective?
QE is basically the central bank creating new digital money, essentially out of nothing, and using it to buy assets, usually government bonds, or, back then, troubled mortgage-backed securities from the banks.
Injecting liquidity into the system.
Injecting liquidity, yes, but the Austrian critique is that it fundamentally devalues all the existing money held by ordinary people. It acts like a hidden tax, an inflation tax hitting savers, and those on fixed incomes the hardest.
Because the new money pushes up prices eventually.
Right. And it distorts the economy. Artificially low interest rates send false signals, encouraging malinvestment. And perhaps most galling to critics, it bailed out the very institutions whose risky behavior contributed to the crisis, while ordinary people felt the pain. It felt deeply unfair and arbitrary.
And Satoshi Nakamoto, Bitcoin's creator, made sure nobody forgot this context. The source highlights that message embedded in the very first block, the Genesis block.
Mine on January 3rd, 2009. It wasn't just code, it contained text.
What did it say?
It was a headline from the UK newspaper. The Times published that exact day. The Times 03 Jan 2009 Chancellor on brink of second bailout for banks.
Wow. So right there, permanently in the first block of the blockchain.
It's a timestamp, yes, but it's also clearly a commentary, a statement of purpose, linking Bitcoin's creation directly to the failure and perceived injustice of the traditional, centrally managed financial system. It's like a digital protest embedded in the code itself.
So beyond the financial instability, the source also emphasizes another major factor, the erosion of financial privacy. This really ramped up after 9/11, didn't it?
Absolutely. The war on terror became the justification for a massive increase in financial surveillance globally, usually framed under anti-money laundering, AML, or counterterrorism financing, CTF rules.
And Ulrich specifically points to one piece of U.S. legislation as a prime example, FATCA.
Yes, the Foreign Account Tax Compliance Act, passed in 2010. This had huge, far-reaching consequences.
How did FATCA impact privacy on a global scale?
Essentially, it strong-armed foreign banks in Switzerland, Singapore, everywhere, into becoming enforcement agents for the U.S. Internal Revenue Service, IRS. They were forced to identify any American clients, monitor their accounts, and report their financial information directly to the IRS. If they refused, they faced severe penalties, like being frozen out of the U.S. financial system.
So suddenly your private Swiss bank account wasn't so private if you were American.
Exactly. It showed that even if you tried to seek financial confidentiality offshore, the centralized institutions holding your money could still be pressured, even forced, by powerful states to violate that privacy. Your bank became an extension of foreign government surveillance.
And this is where Bitcoin presents itself as an alternative, a way to hold and move value without needing that vulnerable intermediary.
Precisely. It offers a way to transact where you don't have to trust a third party that could be compromised, coerced, or simply required by law to hand over your private data.
It puts the control over disclosure back in the hands of the individual holding the keys. A defense against state overreach.
The technological defense, yes.
We've talked about the why, the crisis, the privacy concerns, but what about the how? What actually made Bitcoin technically possible in 2009? The source credits decades of work in specific fields.
Right, it wasn't created in a vacuum. It stands on the shoulders of giants, particularly in cryptography research going back to the cypherpunk movement in the 90s, and also about 2 decades of developing peer-to-peer P2P networks.
The P2P architecture is key for resilience, isn't it? Unlike earlier attempts.
Definitely. Think about something like the original Napster for file sharing. It was P2P for the file transfers, but it relied on central servers to index everything, shut down those servers.
And the network collapses. Easy target.
Right. Bitcoin was designed differently, more like truly decentralized systems like Nutella or Tor. There's no central server, no single point of failure or control. The ledger, the transaction processing, it's all distributed across thousands of nodes run by volunteers all over the world.
Making it incredibly difficult, if not impossible, for any single entity, even a powerful government, to shut it down or censor transactions they don't like.
The cost and coordination required would be astronomical. That distribution is its core strength against central attack.
And underpinning all of this is modern cryptography.
Cryptography provides the trustless guarantees. It offers mathematical proof that transactions are authentic, that the sender actually owns the funds, and that the blockchain's history hasn't been tampered with.
So instead of trusting a bank teller or a regulator,
you trust the math. The cryptographic algorithms ensure integrity, preventing forgery and corruption. It marries the need for security in a decentralized system with the technology capable of providing it without intermediaries. #tags IV, Bitcoin, and Austrian economic theory.
Okay, now let's dive into the heavier theoretical side, the Austrian economics framework that Ulrich uses so effectively. A key concept here is Mises' regression theorem. Why is this theorem so important for arguing that Bitcoin could actually be considered money?
Right. Mises' regression theorem deals with a fundamental question. Where does the value of money come from initially? His argument is that for something to become widely accepted as money, a universal medium of exchange, it must first have had value for some other reason. It needed to be useful as a regular commodity.
We can see that with gold or silver, right?
Yeah.
They were used for jewelry, tools, decoration, long before they were used purely for trade. People value them for those uses first.
Exactly. That prior commodity use value provided the initial anchor for its exchange value. But how do you apply that to Bitcoin? It's purely digital, intangible. It wasn't jewelry.
So how did Bitcoin meet this requirement, according to Ulrich's analysis?
The argument is that Bitcoin did have an initial commodity value, but it was a sort of virtual or subjective use value. Early adopters weren't acquiring it to buy coffee. They valued it for other reasons.
Like what?
Like the utility of participating in a groundbreaking technological experiment, or the value derived from demonstrating complex cryptographic principles, or even the subjective value of using it as a tool for political protest against the existing financial system. It fulfilled a need, a desire, even if that need was intellectual or ideological.
So the value wasn't in physical use, but in the satisfaction of these, well, more abstract desires.
Precisely. And that subjective utility, that virtual commodity value, was enough to satisfy Mises' requirement.
Yeah.
People desired to hold it for these reasons before it started being widely used just for exchange.
And history seems to back this up.
Yeah, the timeline fits. The famous Bitcoin pizza transaction, 10,000 Bitcoins for 2 pizzas back in May 2010, is generally considered the first real-world purchase using Bitcoin purely as a medium of exchange.
And that was well over a year after Bitcoin was created.
Right. The commodity value phase clearly came first. Then the medium of exchange value slowly emerged from that base. It fits the theorem's progression.
Okay, let's talk scarcity again. This is a huge point. Critics often say digital things can be copied infinitely. They can't be scarce. How does Bitcoin claim intangible yet authentic scarcity?
It's a crucial claim. Authentic economic scarcity means if I have something, you can't simultaneously have the exact same thing. My use excludes yours. Bitcoin achieves this through cryptography.
How?
The protocol itself, validated by the entire network, makes it mathematically impossible to spend the same Bitcoin twice. The cryptographic signature required to transfer ownership can only be validly used once for any given Bitcoin. So only one person can provably own and spend a specific Bitcoin or fraction of one at any given moment.
It's scarcity enforced by math, not by physical
And
limits.
exactly. Intangible, yes, but absolutely authentic and non-reproducible within the rules of the system.
And this is where the contrast with modern fiat money becomes really stark.
Very stark. Most money today is already intangible. It's just numbers in bank computers, what Ulrich calls Moeda escritural. The source estimates this makes up anywhere from 52% to over 80% of the money supply in many countries.
So fiat is intangible too.
Yes, but, and this is the critical difference, it is not authentically scarce. Central banks can create more digital fiat essentially at will through QE or other mechanisms. Banks also create new money through fractional reserve lending. Its supply is elastic and politically controlled,
Whereas Bitcoin's supply is mathematically fixed and predictable.
providing the kind of reliable scarcity that proponents argue is essential for sound money, something missing from modern fiat.
Okay, let's tackle the intrinsic value argument. This comes up all the time. Bitcoin isn't backed by anything. It has no intrinsic value. How does the Austrian framework address this?
Well, first, the Austrian school generally dismisses the whole concept of intrinsic value as misleading. Value isn't inherent in an object, it's subjective. It exists in the mind of the individual based on its perceived utility to satisfy their needs or desires.
So things are valuable because people find them valuable.
Exactly. Bitcoin is valuable because users subjectively value the properties it offers. Its proven scarcity, its ease of transfer globally, its resistance to censorship, its security through cryptography, its ability to bypass intermediaries. People value these features, especially compared to the perceived flaws of the alternatives.
What about the idea of backing then? Historically, money like paper notes was often backed by gold, lastro in Portuguese. Gold disciplined the issuers. What backs Bitcoin?
The source argues Bitcoin's backing is its underlying mathematical protocol. The immutable code that guarantees its fixed supply, its transaction rules, its security model, that's the discipline.
So math replaces gold as the disciplining force.
In essence, yes. The predictable, unchangeable rules enforced by the decentralized network provide the same kind of check on arbitrary supply increases that a gold standard aimed to achieve politically. It's technological backing, ensuring monetary discipline through code rather than reliance on promises from politicians or bankers.
Now, a major challenge raised by mainstream economists: deflation. If Bitcoin supply is truly fixed at 21 million and the economy using it grows, doesn't that mean the value of each Bitcoin constantly rises? Prices fall in Bitcoin terms. Isn't that bad?
That's the standard Keynesian fear, yes. The argument is that falling prices, deflation, make people hoard money instead of spending or investing it because they expect it to be worth more tomorrow. This, they claim, stalls economic activity.
How does the Austrian school, through Ulrich, push back against that?
They argue that this confuses two types of deflation. Deflation caused by a collapse in economic activity is bad, but deflation caused by a stable money supply combined with increasing productivity and innovation, meaning goods get cheaper to produce, is actually incredibly beneficial.
Oh, so.
It means the purchasing power of your savings constantly increases. It rewards thrift and long-term planning. Workers' wages, if stable in nominal terms, buy more over time. It encourages sound investment based on real savings, not debt fueled by artificially cheap credit from inflation.
So it's the opposite of the inflation tax. It's like a productivity dividend shared through stable money.
That's the idea. A sound, slightly deflationary currency encourages capital accumulation and reflects real economic progress, rather than discouraging saving through constant debasement.
Okay, but practically, if one Bitcoin becomes worth, say, millions of dollars, how do you buy a coffee? Doesn't it become unusable for small transactions?
That potential issue of high unit value is solved by Bitcoin's design for divisibility.
Right, you mentioned the Satoshi.
Exactly. One Bitcoin is divisible down to 8 decimal places. So 0.000000001 BTC is 1 Satoshi. That's 100 million Satoshis per Bitcoin. Even if a Bitcoin became incredibly valuable, you just transact in smaller fractions, in Satoshis or sats.
And if even that wasn't enough?
The protocol could theoretically be updated by consensus of the network users to allow for even more decimal places if needed in the distant future. It's designed to handle massive increases in purchasing power. It's actually the inverse of hyperinflation, where countries keep having to lop zeros off their currency because it becomes worthless. Bitcoin can just add more decimal points. #tag V. Monetary attributes and comparisons. All right, let's look at how Bitcoin is actually governed, monetarily speaking. Ulrich describes its policy using a specific term, MoMA, which stands for Meta de Oferta Monetaria Asymptotica.
Okay, MMMA, asymptotic monetary supply target. Sounds technical, but what does it mean in simple terms?
It means Bitcoin operates under a strict, predictable, rules-based monetary policy, not a discretionary one like central banks use.
And the asymptotic part refers to the supply curve approaching that 21 million limit over time.
Exactly. The rules dictating the initial supply, the rate of new supply creation through block rewards, and the schedule of the halvings when that reward gets cut are all predefined and embedded in the code. Everyone knows exactly how many Bitcoins will exist next year, in 10 years, even in 100 years.
Unlike central banks where policy can change based on committee decisions or political pressure.
Right. MoMA offers near-perfect predictability of future supply. This certainty is seen as incredibly valuable for economic calculation, long-term investment, and just general stability.
And the source connects this predictability to the impossible trinity concept from economics.
Yes, the idea that a country typically can't have all three of these things at once, a fixed exchange rate, an independent monetary policy, and free movement of capital. Bitcoin, by its very nature, prioritizes having an independent monetary policy set by its code, not a government, and guarantees total freedom of capital flows. Anyone can send or receive Bitcoin globally. It achieves this by letting its exchange rate float freely against other currencies.
Okay, another key advantage highlighted is the lack of counterparty risk when you hold your own Bitcoin. Can you explain what that means?
Counterparty risk is basically the risk that the other side of your financial arrangement will fail to fulfill their obligation. When you deposit money in a bank, the bank is your counterparty. You trust them to keep your money safe and give it back when you ask.
But banks can fail.
They can. And while deposit insurance exists in many places, it has limits, and getting your money back might not be instant or guaranteed in a major crisis. When you hold your own Bitcoin, meaning you control the private keys in your own wallet,
You are your own bank, essentially.
you are. There is no counterparty. The ownership is cryptographically secured directly by you. The risk of a third-party institution failing and taking your assets with it is eliminated.
Which leads directly to the idea of fractional reserve banking. Can banks create more Bitcoin IOUs than actual Bitcoin they hold, like they do with fiat?
In Bitcoin's native form, when transactions are happening peer-to-peer on the blockchain using self-custody wallets, fractional reserve is technically impossible.
Why?
Because the network protocol only validates transactions signed by the actual owner of the cryptographic keys for those specific Bitcoins. You simply cannot spend Bitcoin you don't possess the keys for. The scarcity is enforced mathematically at the base layer. Everyone can audit the blockchain to see the real supply.
But, and this sounds like a big but, the source strongly warns that this risk comes roaring back under certain conditions.
Absolutely. The moment you give up direct control of your private keys and deposit your Bitcoin with a centralized third party like an exchange, a lending platform, or some custodial online wallet, you reintroduce counterparty risk and the possibility of fractional reserves.
Because now you're just trusting that company's promise their IOU.
Precisely. That company could lend out your deposited Bitcoin or use it for other purposes, operating on a fractional basis where they hold less Bitcoin than their customers think they have collectively deposited. If there's a run on that service, they might not be able to honor all withdrawals.
So using third-party services brings back the old risks Bitcoin was designed to eliminate.
It's a critical trade-off: convenience versus control and trustlessness. Bitcoin itself is trustless, but the ecosystem built around it often requires trust in intermediaries.
Okay, let's pull back and use the comparison table suggested in the source, comparing Bitcoin to gold and traditional fiat paper money across key monetary features. This really clarifies the argument for Bitcoin's potential superiority.
Yeah, it's a useful framework. Let's go through them.
Durability.
Gold is highly durable, but can physically wear down. Paper fiat is obviously fragile. Bitcoin, being purely digital data, has perfect durability. The information doesn't degrade.
Divisibility.
Gold is only physically divisible to a certain point, and doing it precisely is costly. Fiat is highly divisible on paper, cents, etc., limited maybe by printing costs for tiny denominations. Bitcoin, with its 8 decimal places and potential for more, offers essentially perfect and costless divisibility.
Malleability, transportability. Gold is malleable but heavy. Fiat is light.
Bitcoin is incorporeal weightless, instantly transferable anywhere with an internet connection. Superior transportability.
Homogeneity, meaning is every unit the same?
Gold needs a saying to verify purity units aren't perfectly identical. Fiat is generally highly homogeneous. $1 bill is like another. Bitcoin is perfectly homogeneous. Each Satoshi is mathematically identical to every other Satoshi.
Offer scarcity. This is a big one.
Gold supply is limited by nature and mining effort, but new discoveries happen. Fiat supply is potentially unlimited, controlled by political decisions. Bitcoin supply is absolutely limited by its mathematical protocol. Unique.
And maybe the most crucial comparison, dependency on fiduciary third parties.
Gold relies heavily on trusted parties for storage, verification, large-scale transport. Fiat is entirely dependent on banks, central banks, payment processors. Bitcoin, when held in self-custody, has low to near zero dependency on intermediaries for basic holding and P2P transactions.
So synthesizing this, the argument is that Bitcoin takes the best properties of both physical and digital money.
Exactly. It aims to combine the hard, reliable scarcity of gold with the ease of use, divisibility, and transportability of digital fiat, while crucially removing the need for most of those trusted, fallible, often state-controlled intermediaries.
It's positioned as a technological upgrade on previous forms of money.
That's the core technological and economic argument presented by Ulrich.
And what about real-world benefits already seen, according to the source?
Two big ones stand out. First, dramatically lower transaction costs, especially for international remittances. Sending money home across borders often incurs fees averaging 9% through traditional services like Western Union. Bitcoin can often do it for less than 1%.
That's huge for people in developing countries.
Massive potential impact on poverty, yeah. It also offers access to basic financial services for the billions who are unbanked or underbanked, much like mobile money services like M-Pesa did in Africa. Second, it's a tool to evade capital controls.
Meaning getting money out of countries with high inflation or oppressive financial regimes.
Exactly. For people facing currency collapse in places like Argentina or Venezuela, Bitcoin offers a way to preserve wealth and transact internationally when the government tries to lock down the official financial system. It's a tool for financial escape.
And the main challenges still facing it.
Primarily volatility. Its price swings wildly compared to major currencies, which makes it difficult to use for everyday payments or stable financial planning right now. The source attributes this mainly to its relative youth and low liquidity compared to global fiat markets, suggesting it should decrease with wider adoption.
Makes sense. Anything else?
The other challenge often cited is its dependence on electricity and the internet. Which is true, you need power and connectivity. But, as the author points out, the entire modern global financial system, including all traditional banking, also depends entirely on electricity and the internet. So it's not a unique weakness to Bitcoin. Hashtag separates in future.
We've established the technical and economic arguments and the historical context of distrust. Now let's focus on the bigger philosophical and political ideal that runs through the source: monetary freedom. Why is having sound, reliable money considered so vital for society?
Because money is more than just currency. It's the fundamental tool that enables complex economies to function. It facilitates trade, specialization, the division of labor, everything that creates prosperity beyond basic subsistence.
So when the state interferes with money,
It causes immense damage. The primary form of state aggression against money, historically and today, is inflation expanding the money supply. This acts as an invisible tax, the inflationary tax.
invisible because it's not legislated like income tax, but it still takes purchasing power away from people.
Exactly. And it's regressive. It disproportionately harms the poor and those on fixed incomes, people whose wages or savings don't keep up with rising prices. This is often explained by the Cantillon effect.
Right. Explain the Cantillon effect simply.
It just means that newly created money doesn't spread through the economy evenly or instantly. It enters at specific points, usually benefiting big banks, government contractors, or those well-connected financially.
They get to spend the new money first, while prices are still low.
Right. By the time that money filters down to average workers or savers, prices have already started rising. So the early recipients gain purchasing power at the expense of the late recipients. Inflation is a hidden wealth transfer from the masses to the politically connected few.
Now, throughout the 20th century, many economists, Mises, Hayek, Rothbard, proposed reforms to fix this, things like returning to gold or allowing private banks to issue competing currencies. But the source says these political solutions all failed. Why?
They ultimately failed because they required the consent and cooperation of the very entities that benefit most from the current inflationary system
Governments.
and the established banking sector.
Governments like having the power to print money to fund spending without raising direct taxes.
Precisely. It funds wars, welfare programs, deficits, all without the immediate political backlash of explicit taxation. Banks benefit from the fractional reserve system and access to cheap central bank credit. Neither group has a strong incentive to give up that power voluntarily through political reform.
And this is where Bitcoin is presented as something radically different. Not a political proposal, but a technological end run around the whole problem.
That's the core thesis. Bitcoin doesn't ask for permission. It bypasses the political system altogether. Ulrich calls it a market invention and evolution that is independent of public consent.
Technology designed to resist monetary tyranny.
Yes. Because governments cannot easily inflate the Bitcoin supply, it's fixed by code. They cannot easily seize Bitcoins held in self-custody without the private keys. They cannot corrupt the ledger because it's decentralized and cryptographically secured. It creates a zone of monetary action outside their traditional levers of control.
Satoshi Nakamoto himself seemed focused on this issue of trust, didn't he? The source quotes him.
Yeah, a famous quote. The basic problem with conventional currency is all the trust that is required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust.
So Bitcoin's goal was to replace that need for trust in fallible human institutions.
With mathematical proof. Trust in cryptography, in the open source code, in the decentralized network consensus, rather than trust in politicians or central bankers. This is why it's sometimes described as enabling the technological separation of state and money.
A separation that political efforts failed to achieve.
For centuries, the market created forms of money, but the state eventually co-opted and monopolized it. Bitcoin, the argument goes, offers a chance for money to emerge again from the market, technologically shielded from state capture.
Looking ahead, the source doesn't necessarily predict Bitcoin will completely eliminate fiat currencies overnight. It sees it more as a complementary asset class, maybe a superior one. What's the ultimate milestone for Bitcoin or any successful digital currency, according to this framework?
The final frontier, the ultimate sign of success, goes beyond just being used for payments, medium of exchange, or for savings, store value. It's becoming the unit of account.
Unit of account, meaning what in practice?
It means it becomes the standard measure stick for economic value. People start pricing goods and services directly in Bitcoin. Companies keep their books and do their financial planning in Bitcoin. Your salary, your rent, the cost of bread, all denominated primarily in Bitcoin or Satoshis, not dollars or euros.
So people would actually think in Bitcoin terms financially.
Yes. That's the final stage of full monetization.
Right.
But that requires a much higher degree of price stability than we see now.
Which comes back to volatility.
Exactly. That shift to unit of account likely only happens if and when volatility dramatically decreases, which would probably require much deeper liquidity, wider adoption, and greater market maturity. It's a long-term prospect.
But even if Bitcoin itself doesn't reach that final stage,
the source suggests the genie is out of the bottle. The idea of a scarce, decentralized digital currency based on these principles has been unleashed. Even if Bitcoin were somehow superseded, something like it is likely to have a lasting, disruptive impact on finance and our relationship with money and the state. #TAC7HU. Badger.
So if we boil down this deep dive, drawing heavily on Ulrich's analysis within Dr. Santushi's series framework, Bitcoin really emerged as a kind of natural, voluntary response to deep-seated problems. It's presented as a technological fix for the age-old issue of state monetary manipulation and the fragility that comes from centralized control.
Yeah, it achieves that hard scarcity, that resilience, but without needing vaults full of gold or relying on promises from banks or governments.
Exactly. It uses math and decentralization to try and deliver a superior form of money, one that potentially shifts power back towards the individual and the free market, away from centralized authorities.
So the final thought for you, our listener, to maybe mull over. The source material pushes us beyond just thinking about Bitcoin's price. It suggests the real test, the true measure of its success, won't be hitting some arbitrary dollar value. It'll be that future moment, if it comes, when people voluntarily choose to use it, not just for sending money or saving, but for their everyday economic calculations. When businesses run their accounts in it, when prices are commonly listed in it, when it becomes the stable unit of account.
That's the point where it would signify a truly fundamental shift in global monetary power.
A shift away from discretionary political control towards predictable mathematical rules. That potential separation of state and money, powered by technology, that's a powerful idea to consider as we watch financial innovation unfold.